Alright guys, John Brees here, and I'm going to do a quick little interview with Trevor Koverko, who is sitting next to me with his lovely, lovely kitty.
My guard cat.
Kitty's the special guest. So, this is basically an introduction not only to Trevor, but also what Trevor happens to do, which is website investing, and it certainly fascinates me because, like many other people who make up part of this scene, what you know of it is what's on Flippa. I mean, a lot of people, that's how they perceive websites, as commodities that could just be flipped like homes, but there's actually a whole lot more to it. But before we get into that, just quickly intro Trevor. Tell us a little bit about, your career, how you got to where you are now.
Yeah, I have had quite an interesting journey to owning a cat. I started out as an athlete. I was a New York Ranger hockey player in the NHL. That's kind of what we do up here in Canada. We play hockey and pretend to be American. But yeah, no, I went from that. I ended up going back to school after my career ended, and I got a business degree. Almost got a business degree because I dropped out and started a company in China. So it kind of took me all over the world, and I got into the whole startup scene and had a lot of fun being an entrepreneur. And then a couple of companies after that, I decided I wanted to change gears. And I had some money from the companies that I sold, that I started, and I wanted to invest. So I went from begging people for money to people begging me for money, and that was kind of a nice change. But my first instincts were to invest in mainstream things like real estate. I bought some houses, student rental houses for income, and those are okay. But I was always kind of a technology guy, and I didn't want to mess around in stocks and bonds and all that. And the stuff that I did invest in mainstream industry, I did not do very well because I was kind of an amateur, and there's sharks in that world. So I decided to start investing in things I knew about, like startups and other small companies that I could add value to. And I still do that to this day. It's still a lot of fun for me and fulfilling. But there's one thing about investing in startups that isn't advisable to your health. The fact that there's a very good possibility that the company's not going to survive. And the money that you put in is going to go to exactly $0. You'd rather them do that because you want the companies to spend that money to invest it to try to grow, because when you have a portfolio of startups, only one or two of them is really going to do well. So for you to make money, you have to make sure the ones that do well do extremely well. That's the venture capital economics.
So actually, I want you to kind of take the viewer through the grid, your investment grid. You covered a lot of different types of businesses there. You covered startups. You mentioned the stock market. You mentioned real estate. So kind of nail it down really quickly. Why is it that you see website investments as superior to all those other asset classes?
Yeah, and I was just finishing saying that I discovered after startups that I could still be in tech but invest in cash flow, not just startups that hopefully make money but might go bankrupt. You can actually invest in businesses that are online that can have a lot of upside but also put money in your pocket. And I think that's what you're touching on now is that if you go through each investment that I've already mentioned, whether it's a stock, real estate, bonds, startups, and websites, so those 5 things all have different characteristics. And for the sake of this discussion, the characteristics I want to talk about are things like, do they generate cash? Does the cash go back to investors? That's kind of number one. Number 2 is, are they cheaply valued? That's an important thing as an investor. You want to buy things that are cheap, that are on sale. So anyways, if I look at, I wrote an article recently that kind of laid this all out visually, but the main kind of takeaway was, if you go through all of the metrics that I look for in an investment, like having cash flow, like being well valued, like having control of the business where you can actually impact the business. If you kind of go through each one of them, there's really only one that satisfies all of my criteria, all of my personal investing criteria that I try to follow. So just quickly, stocks, for instance, I would argue are not cheaply valued right now. The last time I checked, they're still hitting all-time highs. Real estate, that building behind me, we're in Toronto, Canada. It's one of the hottest real estate markets on planet Earth right now. Insane valuations, higher than the US in 2008. No chance. Not going to go dabble at all-time highs.
Wait, we got to tell them. I mean, that condo building behind us, if one of those is a 2-bedroom, we're in downtown Toronto right here, we're probably looking at $600K for that condo unit, plus condo fees, of course.
Yeah, it's crazy. And why 600K? What justifies it being 600K? And there's only one answer for an investor. It's going to go up in value. That's literally the only reason you could justify buying a $600,000 condo in Toronto, because you think it's going to go up in value and you're going to speculate and you're going to get a capital gain at the end of the day. The key word there is speculate. And I am not a speculator. I don't like to gamble, especially with my own money. So, you know, if these condos could rent out for, you know, 10% return every year, cash on cash, now we're talking. Now I'm interested, because now I know my money is putting more money in my pocket at the end of the month. But, you know, these condos here, you're making maybe, you're probably losing money. If you rented it out, by the time you pay your condo fees and the mortgage, you're losing money every month. So real estate, no way.
I actually want to stay on that course, because you mentioned speculation versus generating cash flow. So how about we tie that into FlipUp, because we see that mentality. A lot of people, the second they buy a website on FlipUp, the mentality is, how much can I turn this around for, and what type of work do I have to do to get, like, you know, some money back on top? Why is it that your way of doing things is better?
Yeah, I think it all comes back to what I said earlier, capital gains versus cash flow. If you buy a house and you flip it, which is a perfectly fine business model, but you're going for capital gain. You're buying it and then you're hoping it goes up in value. The way I was taught and the way my instincts tell me to invest is that you should invest in cash flow. If you're going to flip and you want to go buy a website and put a lot of work into it and sell it again and pay capital gains taxes and all that nonsense, all the power to you. But for me, I'd rather just buy something that I like and sit on it and constantly cash flow it until the end of time. That's what Warren Buffett teaches. That's value investing 101, Benjamin Graham, all these titans of investing. They don't get rich by day trading, by buying a stock and selling it a few days later. They buy something that's fundamentally undervalued or produces a ton of cash flow in your pocket. That's how you get rich. And that's kind of what's interesting about what I'm doing now, is combining this technology world of websites being online, this huge macro mega trend of people, you know, spending more time on the internet than watching TV, combined with traditional value investing, combined with Warren Buffett, Benjamin Graham, all these guys. This is kind of an interesting hybrid for me, and that's why I'm so excited about it.
All right, so could you quickly take them through your 5 steps to acquiring a new website? Because that's another thing we see a lot online. People have lost faith in buying websites because, you know, the scams are just so abundant. So what are those 5 essential steps you always take and therefore never lose on your deals?
Yeah, absolutely. We have a framework that works for us, and the way it looks like is we've broken it down into, like you said, 5 very important and very specific steps. Step 1, and by the way, this isn't just for website deals. A lot of other businesses have similar frameworks when they're acquiring a business and doing due diligence. But for us, it means lead generation. That's where it all starts. Sourcing a deal. If you don't have good deal flow, you're not going to make a lot of money. And in today's day and age, it's easy to get deal flow, but to get really, really good deal flow, it still takes a lot of work. So that's step number 1. Maybe we can come back and I can talk a little bit more about exactly how we get good deal flow, but that's number 1. Number 2 is figuring out which one of those deal flow businesses you like, and then going deeper into it, doing a deep dive. Investors call this due diligence, where you verify everything, don't take anything at face value, and that's extremely important prior to doing a deal, doing very rigorous due diligence. So that's step number 2. Step number 3 is negotiating and making an offer. And a lot of really good deals can be life changers if you know how to negotiate and make a good offer. And I can come back a little later and explain how we position ourselves as investors and buyers to benefit extremely well and to mitigate a lot of the risk by the way we structure the negotiation. Step 4 is transition. So that's going from the old owners to me, the new owner. And there's a whole process involved of, do they have any contractors you have to bring over? Do they have any IP? Do they have any legal stuff you got to do? So that's kind of a logistical thing. And then step 5, which is something we've really been focusing on the last 6 months, which is growth, which is taking the business that is now our property, and instead of just sitting on it, that it's getting a good return. John, as you know, you can, if these things didn't grow, they would be phenomenal investments, like best investment in your portfolio. But we're not happy with that. We are greedy, and we want to grow these businesses. We want to take a 30% ROI and turn it into a 300% ROI. And because these are all digital online web businesses, there's a lot of techniques and tactics you can do to improve the website, to drive traffic, to improve your metrics, whatever it may be. And that's becoming one of our core competencies, is growing these businesses in-house.
So would you be at liberty to talk a little bit about one of your latest acquisitions, which was Longtail Pro, which is doing very well on ClickBank?
Yeah, no, just without getting too deeply into the specifics, Longtail Pro is a software business. It's a Google keyword competitive research tool. It's a piece of software that you can download. It's also a web app. And yeah, we had a really fortunate opportunity present itself when a contact of ours, his name's Spencer, and he's the public owner of Longtail. He still is a part owner. And he was selling it. He was kind enough to kind of notify us of this, and we got first dibs on it. And it was just a great company, really well run. The numbers were good. Everything we liked about the deal was great. And the icing on the cake was we trusted the seller, and we had a relationship with them. And that, I shouldn't say it's the icing, that's the cake itself. Like having someone you trust, someone who's got your best interests in mind, is truly the most important thing in a deal. I'm a relationship guy. The first thing I do is get to know the seller, and a good seller, the first thing they do is get to know the buyer. And there's a lot of reasons you do that other than just being a nice guy. You can kind of learn what motivates them, and you can learn what offer to make to them that maybe other people wouldn't be interested in, but because you know that this guy has kids or a family, or he's trying to put someone through college, you can actually leverage that information and use it to get a deal done. So yeah, that was Longtail Pro. It's still fully active. It's been performing great. There's a lot of cool updates.
I think the last time we spoke, you said it's enjoying 10% growth right now.
Yeah, it's growing like crazy without getting too specific.
Yeah.
We're lucky because Spencer built a really powerful growth-based business, and we're just kind of taking what he did and running with it.
Mm-hmm. All right, so we'll wrap it up for now. But we will be coming back to you with even more information courtesy of Trevor over here. So if you need to,